All right, good morning. Welcome to the Short Vol Show Live. My name is David Lincoln, and you are joining me live from Cape Cod, Massachusetts, home of the Pilgrims. And I came on to talk a little bit about earnings plays to start with here. All earnings happens the same way a lot of the time, and I just want to talk about the dynamic that we're dealing with when we come into earnings. And we can use Beyond Meat as an example. What we usually have is usually there are several months of stock options on a stock. Beyond Meat is no exception to that. So currently, for Beyond Meat, we have front week options which expire on Friday, and earnings is next week. So the first week's options will not be around when earnings come out. Thus, they aren't as pumped up as the actual earnings options. So if we look at the volatility levels here to my right, and I guess my screen is, let's see if we can, if you look at this little number that's kind of small to the right, let's see if I can make it bigger for a second. You will see that the volatility levels reflect the fact that the front week doesn't matter for earnings. So, and then the options that expire closest to the time of earnings are usually pumped up the most. So if we look, I'm trying to enlarge this a little bit so we can see it a little better. Okay, so behind me, just to my right there, you can see the numbers. So it says the 26 July options, 85 vol. 2 August options, 128 vol. And so the earnings is going to happen closest to this 2/8 expiration. And that's why those are the most pumped up options. So a lot of the calendar spreads we've been looking at, we're trying to play off the fact that there's different volatilities in different months. We're trying to sell the expensive one and buy the cheaper one. In this case, however, July has been pumped up it's pumped up. I guess it's not pumped up more than usual, but July is basically moot, that first week option. So you can use those to either offset if you're going to buy options for the earnings week, which isn't a bad idea necessarily because this thing could make a big move. Now, if you look just to the right of that number where it says 128.17%, you see plus or minus 33.60. And what that is saying, this is meaning that it's expecting a $33.6 move one way or the other, which, is a pretty big move. But it's reasonable, and in percentage terms, it's not that big. If you think about a $200 stock, a 50% move in a $200 stock would be up, $100. So $33 isn't a huge move, but it is some definite premium to think about. And of course, if you were to buy that straddle, it would cost you a pretty penny. So let's talk about these prices and what's going to happen after earnings. So after earnings, not only is that front week, the 2 August, going to be volatility will be way in, those prices will go way down, but also these other months behind it will go down as well. It's kind of like that sort of tent peg theory. Like if you have a piece of tarp and you were to put a tent peg in it, it's not only going to lift right where the peg is, but the months following it too. So once earnings comes out, things are going to collapse back down to a sort of average, and thus it is advisable to be net short Vega coming out of earnings. And the farther out you're looking with options, the more Vega each option has associated with it. So, a good idea would to be short some sort of farther out month stuff and against your position, no matter what your position is, whether you're long the front month or short the front month, you it would be advisable to be short some of this farther out stuff. And we've noticed actually just in the last week that September, for example, here, it says 90.71 vol. This was up to 92 yesterday, and it's come up, it's come up in sympathy with this earnings stuff. This was down to the mid 80s a couple weeks ago, and now it's up to 90. So I anticipate this going back down to the mid 80s at one point. So I mean, as soon as earnings come out. So this is important that we play this stuff right. Now, this July week stuff, we've had big moves this week, and this stock has been a big mover, all the time. If we look at the chart for a second, it's made some big moves outside of earnings, and it's hard to say if, earnings is going to be a huge driver for this to move or not, because it seems to get up and go just on its own plenty without even earnings to propel it. So what do we have? So this front week seems to me to be a great thing to sell. And if you're, thinking about calendar spreads, kind of the opposite of what a play for me typically is, which would be to buy, say, September and sell this fat August 2 against it. Kind of the opposite of that would be to buy this August right now and sell this July against it. That way you can help finance some units coming into earnings here, because most people, or a lot of people, would actually take their positions off coming into earnings. And I right now have a short strangle position in November, but as opposed to taking it off, I might just want to protect it by just buying a little bit of this August premium, whether it be wings. By wings, I mean far out of the money calls and puts, or something in the middle. And if I want to help finance that, because it's extremely expensive to buy this stuff in August, I might sell a little July now against it and help that finance it. So if you look, for example, there's only a couple days to go in July, so it's starting to collapse pretty rapidly. But if we look at something that's kind of at the money, so let's say August, 200. Let's look at the 205 call. So if we were to buy August 205 call and sell the July 205 call, it's still going to cost us a lot of money, and it's still going to cost us some decay. But let's take a look at this. Now, if I can just isolate this trade from the other trades here for a second. So if we were to buy this a few times, we're collecting theta right now. And remember, that's only for the next day or a couple days until this comes off. But and also, we do have risk with this because it makes us net short gamma. So we do have, when we buy these, if we move far from this July strike, it's going to be painful for us, because we are short those July options against the August. So if you consider that this is probably not going to move around too much in the next couple of days, then this might be a good trade to finance some of this August premium. Now, when we're looking at our risk coming into earnings, we want to actually do exactly that, look at our risk. So what I like to do to look at risk is look at my position and what happens to me for, like, say, a 50% move. What if this goes up 50%? What if this goes up 20%? How do I fare? And to do that, we can go to our Analyze tab in Thinkorswim here. And I have that sort of pulled up right now. And I've got, for a plus or minus 50% move here. And it shows right now, down 50%, I lose $2,000. Up 50%, I lose $11,000. Obviously, my risk to the upside right now. And I am long a couple of these July puts that will come off the sheets at the end of this week. So let's take those puts that I'm long right now off so that they don't distort our view, because I'm not really worried about this week. I'm worried about after this week. So if we take those puts off, then 50% down move, I lose $7,000. 50% up move, I lose $11,000. Now, that's to be expected that there would be losses for a big move because I am short strangles. But we can say to ourselves, how do we chip away at this number? If I move myself over here, if you look to the right and it shows P&L day down 11,000, down 7,000, we want to come up with some sort of strategies to lower our risk for a big move. And so to do that, we can buy some of this August, and we can sell some July against it to kind of offset that. So let's take a look at what happens just with this calendar spread here. If we were to put this calendar spread on and we end up after it with being long 5 of these August 205 calls. So let's just pretend that we bought just straight up 5 of these calls, because that's what we will be left with after expiration. And let's pull that into our Analyze tab. And it's showing just owning 5 of those calls would cost us $220 a day. That including what we already have. That including the theta that we're collecting from our November strangle. So very expensive to own this premium, and obviously just being long these calls would make our delta long, and thus we, to the upside now we're making $33,000 instead of losing it. So let's look at this in a more realistic way and pretend that we bought, let's say, 2 strangles. Instead of buying straight out calls, let's say we bought 2 August 205 strangles. So we can go in here and say August 205 calls, or, well, right now it's 202.65. So let's use the 202.5 strike. So I bought August 2.5 call, and I'm going to hold down control, click on the offer of the put. All right, so that's buying the strangle. So let's say I bought 2 strangles. We can bring that into our Analyze tab here. So buying 2 strangles would cost, $7,000 essentially, and still, that turns us into, it turns our P&L into positive territory for the move, right? But it's costing $217 a day. Let's take that down to 1 straddle. All right, so with 1 straddle, our numbers look great, but our numbers look great. It's costing us a little theta, but notice the Vega number here is still negative. So we would make money. So after earnings, our risk is pared down quite a bit. We still lose some money to the upside for a 50% move, but our risk is pared down quite a bit. And we're still short Vega. So if it actually did make that move, up there we're short 215 Vega. If we go back to saying that we're anticipating this November to come in at least like 5 points down to like 84. Right now it's 89.99. If we anticipate this to come down 5 points, 5 times 200 is 1,000. So that would be $1,000 back to us. And we would still be successful in this trade, but we've taken off a lot of our risk. We've also taken off, from my point of view, a lot of our potential. So what can we do that's better than just buying 2 straddles in the most expensive month? Well, and like I said, I like this position here by doing this because, look, you have much less risk than you did before. You're not losing, you're not losing $11,000 if it goes up 50%. Now, it's pretty unlikely that this goes up 50%, but it could happen. It's not, if it came in and it's up 50%, if this was up to 300 after earnings, it wouldn't be like the shocker of shockers. It could potentially happen. I don't think it's likely, but it could happen. And this way you protect yourself. Well, what's another way that we could protect ourselves from buying straddles? Well, we could buy out of the money calls. because when we looked at our risk here, we see, well, lose 11,000 to the upside, 7,000 to the downside. So there's more risk to the upside, but there's definitely risk to the downside too. So instead of buying the straddle and paying $3,000, what we could do is we could actually just buy strangles, way out of the money call and way out of the money put against the position. So let's take a look at what's out there. Well, it looks like we could pay, let's see, if we paid 45 cents for this 123 put, and then we went out and looked at an out of the money call. So let's look at something like the what if we look at the 300 call, maybe? Look at the 300 call, pay 90 cents. So now we're paying, instead of paying $3,000, we're paying $115. So let's see how that would help our position. Analyze trade. So now, instead of losing 11,000, we're losing 8,000. So we've saved ourselves $3,000 in risk for a 50% move by paying $115. That's much better than paying $3,000, right? What if we buy the strangle twice? Well, now all of a sudden our risk is only $5,000. So for 200, we've saved ourselves. And we're still collecting theta every day, 27 theta, and we're still negative vega, so that when the vol crushes, we will make money on the crush. So this looks like a reasonable thing to do. Now, what if we were to maybe double instead of paying it, $115? What if we were to move these strikes in a little bit closer to at the money? So instead of the 300 call, we move down to, say, the 280 call. Instead of the 123 put, we move down to maybe like the 130 put. Okay, let's see how that does. So now we're up to paying $175. And if we do that once, all right, so that's pretty similar to what we had before. We've chopped $5,000 off our risk to the upside. I'm sorry, $4,000 off our risk to the upside. And our risk to the downside, we've chopped $3,000 off. So for $175, we can take a lot of our risk for an extreme move off. And I think this is something that you should definitely consider. You should have hard, fast figures in your head about how much risk you want to take. The other way we can look at this is we can go over to the side where it says BP effect here and click on that. And this is going to pull up this screen here. Now, if we zoom in on this screen here, it says P and R. This number is very important for when we're looking at our risk. This is going to show what kind of move would make our account go to zero. And, you don't want to have it be like, just a normal, ordinary day move could make our account go to zero. So we look at these numbers. Okay, if this goes down 58%, our account's going to go to zero. We don't really want that to happen. So we want to try to extend this from 58% out to something else, right? So without putting any strangles on, it's 46% down, the account goes to zero, up 50%, the account goes to zero. We want to extend that out. So if we buy one of these strangles, it's extended by 11 points to the upside and 12 points to the downside. So, each time we buy one of these strangles, we are, saving our risk. Well, if I buy 4 strangles, all of a sudden there's no way I can blow out if I have 4 of these strangles, right? However, I'm paying 89 a day in theta, so that's a little bit kind of defeats the purpose of the position to some extent, other than the fact that we are still short vega, and thus we are still collecting money. So what you want to do is you want to find a balance that is acceptable to you and that suits your willingness to take risk. So maybe for you, the balance is, oh, that's fine. I'm willing to accept that I'll blow up my account if this goes up 50%. But maybe you're like, I don't want, no matter what, I don't want to risk all my money. So I'm going to buy enough strangles so that there's no way I can blow out. That would be, sounds like the prudent thing, right? And this, it shows if you buy 2 strangles, then 2 of these strangles for $185, then it takes a 92% move for your account to blow out. So that seems pretty safe. So let's look at just buying 1 strangle. If you buy 1 strangle, you're still collecting $50 in theta per day. It takes a 60% move either way to blow out your account. So 60% move would be, to the upside would be, this goes to 325. So and to the downside, this goes to $80. So does it seem reasonable that this could go up over 300? It seems like it's already at a huge multiple right now. So I don't think it's reasonable that this would go up to 300. But it really depends on what sort of risk you're willing to take. Now, you know, that the guy, James Cordier, that blew out trading the natural gas stuff, his risk was, you know, this PNR number was big for him. That's why, you know, that's why he blew out everybody's account, and they had to send him a check because this PNR number, it went through to the upside, and he was not, you know, he was taking too much risk, and it wasn't hedged. I don't want that to happen to you as well. All right, so I want to move on now to a little discussion about Tesla. So let's take a look at, Twitter. So let's take a look at, well, we'll do both. Let's take a look at Tesla first. So Tesla earnings are due out, I think, today. Yeah. I look sometimes on the StockTwits. There's an earnings calendar there. So if we pull it up real quick, StockTwits, earnings calendar, it shows us, okay, today, Tesla, right? So Tesla after the bell today, earnings. And so in Tesla, I was looking at doing some sort of play where we're buying a farther back month and we're selling this fat premium in the front month. So if we look, the front week is the week because it is going to come out today after the close. So if we look at maybe, and we move out just a week or two, or even if we just look out a week. Okay, so the at the money is maybe the 260 strike. So if we were to buy the 260 strike 9 days out, and if we were to sell it for today, it would cost us $200 each time we do this spread. And then the question is, how much is this going to move, and is this worthwhile to do? So let's put this in 10 times in our analysis tab. So I'm going to go to Analyze Trade, doing the spread 10 times, buying the August-July 260 calendar call spread. So if, according to this, I buy this 10 times, it's going to cost me $2,000, right? It's showing, you know, theta of 824 a day, but that doesn't take into account the fact that this Vega is going to get crushed because if we look here, July is obviously cranked up to 93. August here is lower at 68, but August is still going to go lower from here after earnings come out, of course. But if we go back to our Analyze tab here, we can look at our risk profile, and I'll pull this down so we can see it better. So according to this, the break-even points here are $237 and $287, something like that. So the question is, does Tesla move lower than 237 or 287 from here on earnings? We can back out the chart. We don't know. And does volatility come in more or less? We don't know. I think if we back the chart out a little bit more, it looks a lot more reasonable that this could go below 237 or above 287, right? When you look at it right now. on other earnings, what's happened? Well, right after this one, it ripped way up from 240 to 320. So this particular earnings here, this would not have worked out. This one here, it was down 40 bucks. Down 40 bucks. It's a loser as well. This earnings here, however, it didn't move hardly at all. So in this most recent earnings, this would have been a winning trade. But it really depends on your assessment of Tesla. Now, the other trade we could do, other than the trading the front 2 weeks, is we could buy a farther out month. So let's take a look at maybe September. So if we looked at the September, and you could, if you think it's going higher, you could pick, usually with these calendar spreads, you want to pick which month you think this is going to end up at. But if we just assume we don't know where it's going to end up, you'd pick the at the money. So if we were to buy the September 260 call and sell the front week 260 call, that would cost $11. So it's $1,100 each calendar spread. So you're dealing with some real money here. But I think that these are definitely doable. And you might want, what you might want to do is just track this a couple times. So instead of actually putting the trade on this earnings, paper trade it for an earnings, see how it works out. But I kind of like this this one, just the front 2 weeks. You're risking $200 each spread, and I kind of like it because remember we were talking about the last time we were talking about these with Chewy and Skechers. The numbers were like $1 and 70 cents. These numbers are bigger here. It's $11 versus $9, and so there it feels like there's more room for these to for this spread to expand here, because you've got bigger numbers involved. So there's more potential in this than doing one of those, like the Chewy spread worked out for us. The Skechers one didn't. This seems interesting to me. Buying the August 260 call and selling the 26 July 260 call. Earnings come out tonight. You're going to know by the end of the day tomorrow if it was a winner or not. So it's just a one night overnight trade. You buy the spread, you sell it tomorrow. Good thing about Tesla is there's enough liquidity to play with this and put it on, take it off very easily. Okay, let's take a look for earnings at Twitter, however. Twitter. And if we go to our handy dandy earnings calendar here, we can see that Twitter earnings are on Friday before the bell. So once again, July 189 bid at 195, representing 132 vol, and then just real close after that is August. And once again, these are more dollar cheap stuff. So let's go to like August, 23 days out August. So if we were to buy the at the money, let's say the 38 strike in August, pay $224, and sell the at the money strike in July, 189, you're paying 30 cents for the spread. So you're only risking 30 cents. So we like that. But it might just be a nothing trade, and depending on if this makes a big enough move, the strike might be kind of worthless. But let's pull this into our Analyze tab and see where we end up. So according to this, you're a winner between, and this is not including, once again, the Vega crushes, but according to this, you're a winner between 32.5 and 45.5. So that seems like a reasonable level of winning there. So I kind of like this trade. It's the August, July 38 call spread, paying 30 cents. You can try to model it. Once again, maybe try this really small for one earnings cycle, see how it works out for you. The big one I had this year that was a big winner was this ICPT, which was like a a $2,800 overnight winner on that one, which was great because this little account that I was playing with back then had only like $3,000 in it. So to have a $2,700 winner was great overnight. Anyway, so let's go back and see what other earnings we've got. So we've got Facebook. Facebook's been much talked about due to not only the Libra thing, but antitrust stuff, and Facebook currently down. So Facebook, let's see, earnings after the bell, it's down 5 right now. Volatility is starting to crank on this one, and this is actually, Facebook has actually become interesting. And, of course, the good thing about Facebook, once again, is there is liquidity in here. So you can get in and out of trades, which is really important with this sort of trade. So let's look at buying the August 200 call and selling the 26 July 200 call. So it's $1.55 for the spread. If we put it on, and I know there's plenty of other options earnings plays to do, but I'm just focusing on this one for right now so that you can, so that we kind of keep this conversation focused. Okay, so it says between 175 and 235, you're essentially a winner. This is set to the wrong day, of course. That's why it's showing negative stuff. So let me see if I can fix that. All right, so anyways, this thing slid over, so you can't. Here we go. Oh no, it's set to the right day. It's just the numbers are not lined up because it's using the prices from yesterday. That's why it's giving you strange P&L figures here. But if we pull this into our Analyze tab here, it's showing, between 175 and 234 as a winner. So take a look at this one also. Of all of these, I think I like the Tesla one the best, but there is definitely some premium in this Facebook, and this is the highest volatility I've seen here in a while. So that's kind of exciting that this Facebook is a real player, man. I mean, there's money to be made out here in Facebook. Check this one out, and this is going to be a mover, and there's premium in these options. I mean, this is a volatility stuff. This is tradable stuff, folks. So that's always good news. All right, so as we approach the open, I'm going to leave you for now. Great luck with your trading today. I'm still deciding what I'm going to do with BYND, but I think I will buy at least one of those strangles to protect myself, because you don't necessarily want to risk it all on one trade ever. Of course not. Why would you want to do that? Thanks for watching, and we'll see you in the next one.